Hey guys, how's it going?
Excellent.
So everyone knows Index Ventures. You guys have backed a lot of great companies, including Datadog, Figma, Service Titan, list goes on and on. But you actually only came to SF 13 years ago, so you're a relative newcomer on the block. So I'm curious, just tell me a little bit about the firm and how you guys have been able to build that track record.
Great. Well, thank you, Berber. And it's so awesome to see so many familiar faces in the audience. You know, when it comes to Index, the thing that we really pride ourselves on is that we are one global team with a lot of trust. So we're one investment committee across Europe and the United States. And that's given us a really wide purview of different sectors and geos, and also a really diverse pool of entrepreneurs to invest in. And then when it comes to our investment strategy, there's really three things that we pride ourselves on. One is we're very aggressive. As you said, we've only been in the Valley for 13 years, and so we really have to have an underdog mentality and be super scrappy and win as a team, and that's served us super well. The second thing is, you know, we've been really disciplined. If you think about the storyline of Index, we have really stuck to what we said we were going to do with our LPs. So in the moment of crypto, when we looked like we were leaving a lot of money on the table in the short term, we decided not to do crypto because none of our partners could get conviction around investing in that theme. Second, when everybody was raising a crossover fund, we decided to double down on what we really are all about, which is early stage investing, and we raised a seed fund. And then the last thing I would say is we're all about the people. The decisions we make are truly so focused on the entrepreneur. And most of our strategy is building deep, deep relationships with these individuals that are putting everything on their life on the line to run these companies. And I'm going to call Shardul out for a second because he's done a phenomenal job of this with a company that some of you may have heard called Wiz. Just to give you the context, Wiz is one of the fastest or the fastest growing company out there. It's gone from 0 to 350 million of ARR in 3 years. And Shardul had built such an amazing personal relationship and business relationship with Asaf that when he decided to leave Microsoft, where he was leading cloud security, and start his new venture, Shardul was his first call. And as a result, Index is the biggest shareholder of the company. And so I think that's really a testament to how seriously we take relationships.
And you guys are the largest shareholder in Figma, right? Outside shareholder? So we were talking backstage about how the last 30 days have actually been super busy for you guys, one of the most active periods actually in the firm's history. So I'm curious to learn a little bit more about that. Is that all AI? Is that Fintech? Is that cybersecurity? Like, what's all the buzz about right now?
Yeah, and by the way, we're hiring Berber, so in case you want to jump, like that was the pitch. The last 30 days definitely suggests that we're moving out of the VC winter of 2023 into like a VC spring. Like the sun is shining, to your point, outside of AI. Like we're seeing broad-based activity across stages, across geographies, across domains. So exactly to your point, we've seen investment opportunities in and made decisions and won deals in consumer, in SaaS, in fintech, in cybersecurity, and of course, AI. The good news is we are winning, again, in the most active moment in the last 30 years. And it's kind of hard to lose when you have a partner like Nina. She is literally the most competitive person that I've ever met. And a number of you in the room have probably witnessed this. Like, you know, the most recent Series A, I think she kind of trounced 5 of you in the audience, and probably half of you didn't even see the deal.
What was the company?
Well, it's not announced yet, but it's a really exciting company. It's an entrepreneur that we had been building a relationship with for a year. And he really wanted to empower industrial designers to take their creativity and then accelerate the drawings that they were drawing on paper of cars and purses and sneakers, and use AI to help them take that design and turn it into a 3D model. So we're really excited about it.
Can we promise we'll give Berber the first call on the exclusive story about the company?
So a lot of people are talking about AI now. It's the buzzword of the Valley. Earlier today, Brian at Founders Fund talked about how the least contrarian thing you can do now is to invest in AI. And so I'm curious how you guys are thinking about that sector and where you think VCs can win, in particular, given the competition from the big tech companies, given the capital-intensive nature of a lot of these LLM businesses. And how has that changed since ChatGPT was first released? Like, how has your thinking on the VC opportunity evolved over time?
Yeah, so I think when the first announcements started coming out about this incredible technological advancements, a lot of VCs, ourselves included, were sitting in a room thinking, okay, so what is the technology that we need to take a bet on? Because this is moving so quickly, and are we going to take a bet on large language models, small models, open source? And I think we got to a point over the last year where we're like, let's not kid ourselves. We are not going to sit here and determine what is going to be the next technological breakthrough, because frankly, actually last night I was at a dinner with a bunch of AI researchers from DeepMind, OpenAI, Anthropic, and they were all saying that how they themselves were so surprised at the turns and twists that the technology that they are in the front seat of building has taken. And so for us, it was just kind of a reminder that we need to bet on the people, not on the technology, because the technology is changing so quickly. So you want to invest in someone that is close to the cutting edge research, that can attract great talent, but that is truly looking for product market fit and solving a real problem with real ROI. And so I think it's been good to go back to that framework for investing in AI.
Yeah, and maybe to complement, within AI, there's probably 3 levels that we think about. Native AI applications, picks and shovels that support AI applications, and then, of course, LLMs, which I think you were alluding to. And within those 3 buckets, the majority of our investments have gone towards the first 2 layers. Native applications, which, again, extend to a variety of industries, and picks and shovels, like open source databases or security services that service that market. But importantly, AI is definitely a draft that's pulling other existing markets into a new opportunity set. Think about it. 5 years ago, if you happened to be a criminal, writing an email phishing campaign was riddled with poor grammar, poor syntax, and was kind of easy for us to identify, right? We've all seen it when you get a text message or an email where someone asks you for your bank account details. Today, the same criminal is using better grammar, better syntax, and the reachability of email phishing has significantly increased. So an existing category within security like email, which has produced winners like Proofpoint and Mimecast and many other public companies, is now seeing a resurgence because of AI. So it's not just about investing in AI per se, but recognizing that so many different industries are affected by changes in AI.
Do you feel like the competitive dynamics between VCs have changed at all with AI? Firms, in terms of the skill set you need to win deals, the networks you need to have with founders, is there anything on the sort of competition level that you feel like has changed when it comes to winning these hot AI deals?
Well, I'd say overall, of course, as we know, the venture industry has really consolidated. It's not the long tail of smaller funds that are competing in every deal. So I think it's gone back to very much what it was before COVID. I think the challenging thing is just that the rounds are so big, and that a lot of the money in the round is actually going just straight to compute. And so all of a sudden, your seed round that used to be, $3 to $5 million is now $25 million, because the company needs to spend money to iterate, spend money on R&D. And so that actually makes the competition concentrate in some of the bigger funds.
Yeah, I mean, why is our win rate so high, right? It's because we fundamentally focus on references, right? That is the tool that allows us to have accessibility to great entrepreneurs, to convince the entrepreneurs to work with us and subsequently support them in building their company. So in some sense, our industry has always been competitive around the best entrepreneurs, but in focusing on relationships versus deals, right, and thinking about deal flow, I think we position ourselves fundamentally differently. That said, co-opetition amongst our peers is nothing new, right? The folks that Nina trounced for this company may be terrific investors in the Series B of the business. And for some of the more capital-intensive companies that raise sizable seed rounds, often we are participating together with other great investors. So I don't think there's anything really different about the competitive nature in our industry.
Yeah. One thing you mentioned is compute, and that's kind of like the new hot currency amongst a lot of AI startups that are research intensive. And, we've heard a lot about, the advantage that some of the big tech companies have in terms of being able to offer, cloud computing and coupling that with chips for training and inference. You guys did a partnership last year, I think, with Oracle to help startups get access to some of that compute. So I'm curious to get your thinking on like how that got started. What does that program look like? Has it been helpful for winning deals, for helping founders build their businesses?
Yeah, if I take a step back, thanks to Los Angeles, over a decade ago, Andreessen Horowitz brought in a different approach to the venture industry, like the services model, that a number of firms ended up having different efforts and attempts around. That was interesting and a change in our industry. One of the, I think, offshoots of that effort has been a more recent kind of industrialization of large venture firms in the hopes of professionalizing the business so that products or services could be repeated and scaled to a range of entrepreneurs. It sounds good, right? We take a totally different approach. We think it's people-centric, not one size fits all for every company. And so an example of that is kind of the Oracle partnership that you're alluding to. We identified for a few companies, there was an opportunity to not buy chips, which money can buy chips and anybody can do that in an undifferentiated manner, but to help curate the relationship with a set of decisions around why interconnect speed matters, how to engage with Oracle, and how to graduate into their own set of programs. But importantly, to your point, the result, the exhaust of that work is a point of view we took on data center optimization, as an example, which definitely led us to, again, a recent investment in the last 4 weeks that we'll give you a heads up on Berber first.
So you mentioned that we're heading into VC spring, and that was an interesting observation because I feel like on a macro level, like deal volumes are still down from 21. The IPO market is still closed. A lot of the VC-backed companies that went public are still trading below, what they were trading 2 or 3 years ago. So, I mean, is that a macro level change? Is that a shift in technology and in new markets being open? Like, I'm curious, what makes you so optimistic that we're really rounding the corner on the sort of scary VC winter?
Yeah, well, I definitely think it's probably more pronounced in AI, for sure. Now, all of a sudden, as we said, there's this incredible technology and people are really excited, and there's capital open to go and raise your first round and leave, the big tech company or wherever you were to start a company. I would say it's probably a tale of two cities, right? There are so many SaaS companies that really overcorrected on just like slamming on the brakes on growth for profitability. And I really feel for these entrepreneurs because the narrative was public markets only care about profitability. Well, that really trickled down to like Series C, Series B. And now a lot of these companies are like in no man land where they are not growing super fast and they're barely profitable or, almost profitable. And they need to come out and fundraise for capital. I think we did an analysis where there's like 432 companies in the US backed by our peer set, Series B and above, valued below $2 billion that has not raised capital in 24 months. Well, guess what? These companies are going to come to market. And I think it's going to be very difficult for them because it's a little bit hard to think about, okay, well, now can they reaccelerate growth? And I actually think the question is going to come down to how much conviction do you have that they have true product market fit, which means you can charge enough for your product to justify the cost of serving it eventually. And so I do think it is pretty tough for some of the companies out there that didn't have this AI tailwind, and I think you're absolutely right.
So the VC spring really is about AI mostly then?
No.
I would
Did
say
you
no.
not listen to anything
What else?
we talked about?
Crypto, fintech,
Not crypto. We're not crypto.
not crypto. Okay.
Fintech is seeing a resurgence, right? Like 2023, public market fintech companies were down something like 75%. So sure, that trickles down to Nina's point, where people are now, entrepreneurs importantly, are thinking, should we start a fintech company? And existing fintech companies are curious if they're going to be able to exceed their existing valuations. And so they take corrective measures in trying to survive versus thrive. Again, in the last 4 weeks, 2 fintech investments we've made. So it's not just AI. I'm telling you, it's not optimism. It's true.
Are those like neobanks, stock trading apps? Like what type of fintech companies are they?
Infrastructure to fintech companies. One of my companies that services fintech businesses just signed a Series A term sheet. That's not even among the list of companies that I'm alluding to. It's across the board. We're evaluating a neobank right now. It's broad-based by stage, by geography, and domain. It's not just AI.
But do you think that's a function of just like the incredible amount of dry capital VCs have had? 2023 was like the lowest record of capital deployed, right? So do you think it's just a function of that, or do you think there's some other tailwind that's enabling the fintech company to go out to market and raise successfully?
We should ask Berber. What do you think?
Oh, I don't know. I'm the reporter. I'm supposed to be asking you the questions. But now that you mentioned dry powder, you guys did raise
perfect deflection. Did you see that? That was beautiful.
My editors are more interested in AI. Fintech is not the big category now. But dry powder, you guys raised a big growth fund during the bull market. A lot of growth funds. There hasn't been that much activity there, and it seems like you're talking about a lot of the activity around AI and fintech is at the earlier stages. So I'm curious, have you guys been investing actively out of the growth fund? What's the thinking around raising a new growth fund, the sizing there? I'm curious to get your thoughts.
Well, definitely given the dynamic I mentioned, that a lot of these companies that had raised capital now need to come back, that is happening. So we just did a $100 million growth check deal in Europe that we recently announced. And then one of these companies that Shardul mentioned is also a growth company. So I definitely think those companies are going to come back to market. I think it'll probably be binary in terms of there'll be a bid for the companies that still have shown that they can grow and they can do it with unit economics that are believable and scalable. I think the other camp is going to have a lot harder time raising growth rounds in this environment.
Gotcha. And you guys are stage agnostic in terms of investors. Like you don't have investors siloed doing growth deals versus early deals.
Yeah, we're very, yes, we're one of the few funds, maybe the only fund that has a seed fund, venture fund, growth fund, but the same team investing across stages. And that's because we think there's a huge advantage if you're going super deep on a space. You're almost like handcuffed if you can't invest in the cutting edge company in that space, or if your thesis shows and your analysis shows that, actually like this incumbent is actually going to be the winner and they have huge opportunities for more growth and you can't invest in that. So that's why we try to look at the entire stage very holistically to be able to pick the best investment across that particular theme and sector.
So another thing I wanted to ask about Index is, in the past year, 2 of your partners have stepped back, Mike Volpe and Mark Goldberg. They were both based out of SF, did a lot of great deals for the firm. And I feel like in VC more generally, we're seeing generational transfer happen at firms like Sequoia and Andreessen with Jeff Jordan and even Greylock with Reid Hoffman stepping back from the next fund. So I'm curious, what has that been like? Do you see this as an opportunity? Are there holes you feel like you need to fill within the team?
We are definitely recruiting you, Berber.
I would not be a very good VC.
Look, we have about 30 investors globally, evenly distributed across San Francisco, New York, and London. Generational change is a really important subject, particularly for a partnership, right? There are other organizations that might have a hierarchical structure. For a partnership, considering generational changes is really critical. You in a partnership, where you're exposed to the power law of our industry. As many of you know, in a portfolio of approximately 40 companies, only 3 or 4 are going to create disproportionate returns and proceeds for the fund. That can result in ego in an organization. So for decades, I think firms have been trying to think about what are appropriate approaches to setting up a franchise that outlives an individual. And so we've been thinking about this for 30 years in terms of how to set ourselves up for success. And what I'm super proud of is that the majority of our partners have been developed internally within Index. Nina started years ago, Jan started years ago, Martin started years ago. For God's sakes, I started as an intern.
Oh, wow. When was that?
Don't date me.
13 years ago.
More than 16, but neither here nor there.
So are you looking to fill the spots that were sort of replaced with those spots from those 2 left with new GPs, or you mentioned you were hiring, so.
Well, we're always looking for great talent. That's the party line. But no, look, I think ultimately we don't think venture is a super scalable business because it's so driven and grounded in the relationship with these entrepreneurs. And so I think we will always have a small, scrappy team. I think we've been incredibly disciplined on not raising bigger and bigger funds and keeping it, to a size that we feel comfortable with the team that we have. We're always looking for great talent. We just brought on an incredible new partner. His name is Vlad. He spent 10 years at Airbnb building their core business alongside Brian Chesky there. And he's going to focus on consumer and gaming in San Francisco. So we're really excited about the team that we have.
And you guys are interesting because it's a more geographically dispersed firm. You guys were founded in Geneva. I assume you don't have any investors working in Geneva.
No investors.
Unless there's some Switzerland startups that I don't know about. But you guys are a very geographically dispersed firm, but a lot of the activity is happening in SF now. A lot of founders are coming back, investors are coming back. So I'm curious, how does that work? Shardul, are you flying in a lot in SF, or do you feel like there's a lot of activity in New York? I'm curious, how you think about the
I have like 40 seconds. First, just to handle the insult.
Oh, God, we're out of time.
I started my career in Geneva. You're right.
You did?
There's not an active venture scene in Geneva. But that forced us to be really thoughtful about going to entrepreneurs because there's opportunity everywhere. And we have to be really respectful with whom we would spend time with. And I think that's part of the ethos that Nina alludes to. And it carries on to today. Yes, I live in New York. I think 3 of the last 4 investments I've made just happen to be on the West Coast. One is split between Israel and New York. We go to where the best founders are. There's no limit geographically on it.
Great. Well, thanks so much for coming to speak, and hope we can do it again next year.
Thank you.
Thank you.